What's going on, everybody? Good evening. Welcome in. We're going to get this one going in just a couple minutes. Just going to give everybody the chance to hop on in before we get started. How's everybody doing tonight? Good to hear it, Spike. Definitely quite the interesting day in markets. We'll talk a little bit about it before we get too deep into talking about selecting contracts in specific. Extra entries today because of a work call. It happens. Can't really get too worked up about that type of stuff, honestly. There's always going to be another opportunity, so you really can't let it get to you too much. Think we bottomed out, Gary. Okay. We'll talk a little bit about it, talk about maybe a trade plan from here. I'm going to send out one more message letting everybody know we're getting started, and then we'll get into it. All right. Let me get that out. Cool. Okay. Well, it is a couple minutes after the hour. How's it going, Christian? So we might as well get going into it. Definitely a thinner crowd tonight, but that's okay. We'll make the most of it either way. So welcome in, everybody. Welcome to the lecture for this evening. The title of this lecture was originally titled Strike Prices, but we're going to talk about a little bit more than just that. So big idea of what we're going to cover tonight is about selecting contracts or selecting option contracts. And then also we'll start to talk a little bit more about how that kind of ties in with the type of trade that you're looking to take, because there definitely is a very strong relationship between the two, right? You can't really select a valid contract without understanding exactly what your strategy is and how you're looking to trade a given equity, and vice versa. So to start this one off, I want to just start by kind of talking about where the market is at currently, and almost outline a little bit of a trade idea in a sense, and then kind of go from there. So let me just clean this all up real quick and get us a nice clean slate to start from. So carrying over from our lecture last week, I want to just kind of run through some of the things that we talked about just to kind of remind everybody about the concepts, because it definitely all still does apply. So, oh wow, flips in lecture. I haven't seen flips in a while. Hang on. What's up, Flips?
What's good, boss? How are you?
I'm good, dude. It's good to see you. How was Mastermind?
Oh man, can't complain. We should
No?
ask them if you have any members here that were there, just ask them.
Yeah, they had a good time.
I hope so. Shit, freaking kill myself. I want to make sure that everybody had the best experience ever.
That's good. I'm happy to hear that. Well, it's good to hear from you, brother. I'll have to make sure to. Oh yeah, we got a couple. SK says it went great. iPhone misses it, wants to do it again. Already, Flips. They already want to do it again.
Yeah, a lot of people ask for Mastermind 2.0.
That's they want more, Flips. They want more. Tell them you got to have a little bit of a break first. That's funny. I'm gonna let the team know that you're in here just in case anybody wants to ask you questions while you're here. I'm gonna say
Yeah,
Flips
man.
joining
I'll
us
be here.
for the first part of lecture tonight. If you like to come say hi. All right. So what we talked about last week is we covered support and resistance, and obviously, generally speaking, it can be thought of as a reasonably basic concept. So want to just kind of carry that over a little bit to this week, kind of give ourselves a framework for the S&P, a little bit of a workup, kind of think through some trade ideas, key levels, and then talk about how to select, some potential contracts in order to trade some of these moves. So as we discussed in last week's lecture, always very important to start by charting those key levels off of the higher time frames. So first example I'm going to start with is this all-time high level on the weekly. Just going to mark that off as 560, 565.16. As we talked about last week, I like to give that a little bit of a color as well. Also sometimes a label. So I'll label this one ATH for all-time high. Show that on the right. And then also just take note of the overall weekly trend, which right now, weekly trend is very clearly up, right? The moving averages are trending positively. We're setting higher highs and higher lows. So there's no way to deny that this trend is currently up. Moving on, right? Next step is always going to be zooming in on the daily. Generally speaking, doesn't hurt to kind of clean those levels up a little bit. So for example, I might start this just a couple days earlier to make it look a bit cleaner here on the daily. And then as we talked about, right, moving on to our lower time frames, we really want to be charting those key kind of important pivots and any other significant levels. So those are kind of two main places those key levels can come from. In my opinion, right, one of those key levels has got to come from right around these range lows here, which is going to be your 555-ish area. So I'll just go ahead and mark that out right there, right around 555. Kind of the next key level below that is going to be this gap right here, set on the daily. So the high and low of that gap here, right around 548, and here, right around 545. And then again, kind of next key level below that, we could even take a look at the profile as well, just to get some extra kind of confidence in what we're drawing out here. Let me just get the other version. So again, as we talked about last week, right, we want to look for these volume shelves in order to find real high quality areas of support and resistance, which really below this 545 area, there's not much supporting price until all the way down to this 530 area. So this is probably going to be the next level that I mark off right around here. And then below that, again, still not too much. Probably we'll just leave it at that for now. So again, purpose behind this is number one, to reinforce the concepts that we talked about last week. And then also to number two, help give us a framework to actually, talk about ways to select an option contract. So right now, based on where we're trading in this specific area, we talked about this level last week here, this kind of 555 zone low. Really, we identified that the S&P was in a range, kind of stuck between the all-time highs and this 555, and really not much to do until we break this range, which as of yesterday, we have broken this range to the downside. So at this point, right, it's going to be a little bit more difficult to be more bullish than bearish until we see some more positive action back above the 555. So with that said, there's a couple kind of ways we could start to structure a trade. I'm going to try and not focus too much on kind of developing the trade idea. I'll say definitely a little bit of a kind of, I'll say a decent place to give the market a bit of time to kind of figure itself out, right? We're below the moving averages, but they're still trending positively. So certainly possible to get bounced back above here. If I was looking to get long, I'd probably wait to do it until we get back through this 555 area. And at this point, if looking for lower, probably wait till we break below today's lows right around the 549.50 area. So with that said, right, let's say, for example, I'm looking to structure a trade to the short side, right? I'm looking to get short on the market. Obviously, at that point, right, I'm going to be taking puts, right? That's going to be the only way that I'll be able to short the market with option contracts. So with that in mind, right, and also understanding that this setup that we're trading is coming from the daily chart, we know that if we're trading a setup that's on the daily, there's a good chance there's no reason for us to be trading something like same day contracts. And what I mean when I say same day contracts is contracts that literally expire that day. And this is kind of the first rule of thumb to be mindful of when you're selecting an option contract is that the time until expiration on that contract, generally speaking, should line up with the time frame of that trade that you're taking. So, for example, somebody like Flips is pretty often day trading off of the 5 minute time frame, and he's looking for kind of those small moves off the EMAs. Well, not looking for the small moves, getting the big moves, but yeah, typically trading those kind of smaller moves on the 5 minute. And as a result, right, it doesn't make sense for Flips or other day traders to be trading something like a leap with months and months and months to expiration, right? It makes more sense to have something that's a bit shorter time till expiration, right? Because as we decrease that time till expiration, the ratio of the delta of the option contract to the overall price increases. And we'll talk a little bit about what that means in just a bit, but just trying to introduce these high level concepts here first. So again, if we're starting off our trade idea from the daily time frame, odds are we should likely be having or be trading a contract that corresponds roughly to a similar kind of time horizon. So let's just take a look at the options chain really quick for the SPY. So for those of you who aren't familiar, this is Thinkorswim, and this is the options chain in Thinkorswim. Oh, and also Flipped, if you have anything to add, you can feel free to mention it at any time.
No, I mean you're right on point. It's two different types of trading. Definitely, I'm looking more at my entries on the 5 minutes, my charting as on the 4 hour and in the hourly. And definitely when you look at time frames and a bigger, then if you don't want to be stuck in front of the computer all day long, this is the perfect way how to do it.
Right.
Is you take a longer expiration contract and looking at stuff to play out in a longer time frame.
Right. Exactly. Yeah, that's exactly the idea. And I think you hit the nail on the head, right? It's really two different types of trading that we're talking about here, right? When you're trading based off of the higher time frames, like the weekly, the daily, even the 4 hour, right? I mean, if you look at Flips and he's screen sharing in VC, or I don't know what he was doing in Mastermind, but in Mastermind, right? Flips, I'm assuming, right, when you're showing your screen and talking about your entries, you're only talking about the 5 minute and you're trading weeklies or same days, right? That's it. And
Yeah,
you're let.
that's 100% correct. I looked at stuff in the hourly, and I start drawing my levels, and then I go to a smaller time frame, like you said, in the 5 minute, and I wait for that touch, and I try to snipe that touch.
And again, those trades that you're taking are short term, right? When Flips is entering trades in VC, he's entering and he could be trimming in 2 minutes, 1 minute, right? Whereas somebody like a swing trader won't be trimming maybe for a day or a week, right? So we'll talk a little bit about kind of what actually is changing in the kind of difference of time frame contract, but let's just dig into it a bit more. So here you can see the full options chain for the S&P 500, or I should say that for the SPY. So on the left here, you can see all the expiration dates available. So we have these kind of weekly contracts or same days up close to the top of the list. And as we continue down the list, the time till expiration gets longer and longer. So you can see in parentheses the time till expiration. Generally speaking, me personally, if I am trading a setup based on the daily time frame, I'm going to want around 2 weeks till expiration or more, depending on the setup, right? For me personally, 2 weeks approximately till expiration is really the minimum for me. And again, that doesn't necessarily need to be the same for everybody, but generally speaking, that's my kind of number one rule. So some expirations that would be favorable to me. If we take a look at the calendar here, me personally, if I'm as a swing trader, right, I'm typically looking at the standard expiration date, which is always going to be Friday. For instruments like the S&P, you have the opportunity to trade anything from Monday to Friday. So you have a bit more flexibility there. But in general, generally like to pick that Friday expiration. So the options for me, if I'm taking some kind of swing trade on the SPY, are going to be likely this September 13th expiration, September 20th, or the 27th. And what we can do is start to look into these chains and show a bit less contracts. So we'll look at the 13th, we'll look at the 20th, and we'll look at the 27th. And you should be able to see the difference, right? So if we look at the 552 call strike for each one of these contracts, you can see the shorter term expiration is about $554. The next week is about $719. And the following week is about $832. So as we add more time until expiration, the price of the contract increases. And the reasoning behind that is because contract value decays as expiration nears. It's one of the most important options Greeks. It's called theta. Not going to explain it in too much detail, but essentially the closer you get to expiration, the more an option's value degrades. So for example, if you look at something expiring tomorrow, it's only $139 as opposed to something in 9 days, which is $554. So that contract really whittles away rather quickly. So for this specific example, in terms of selecting what I would most likely want to trade here, my first step is looking at volume in this left column and open interest, right? What those two terms represent is essentially the interest of other participants in the marketplace in that specific contract. So volume represents how many times a contract has changed hands throughout a day, and the open interest represents the number of contracts that actually exist or are being held in somebody's portfolio as of the prior market close. So this open interest was likely last updated at the end of or at the beginning of the day at market open, and it will be updated again tomorrow at the beginning of the day. So as we came into today, September 4th, there was 823 of these 552 calls being held in somebody's portfolio. But today, those contracts were traded 3,900 times. So that could mean one of two things. Either these 800 contracts exchanged a lot, or more contracts were created, which if somebody sells to open a contract and somebody buys that contract, a new contract is created essentially, which I'm going to try and avoid from explaining the nuance of that for now. So that's the first thing that I look at. It depends, just like kind of analyzing volume on given stocks though, it always depends on the different equity that you're looking at. For something like the S&P, you really got to see kind of minimum 500 volume and 500 OI to be interested, because there's so many better options, so many high volume, high open interest options. I mean, you look at the tomorrow expirations, these all have, in the tens of thousands of volume. So this is a very liquid options chain, meaning it's traded a lot of people are interested in it. So automatically, right, if we look at the 552 strike for September 13th, the 552 strike for September 20th, and the 552 strike for September 27th, there's one glaring difference between these three, which is the September 27th effectively has minimal volume and open interest on that given strike, which means automatically, if I'm looking to trade this 552 strike, this chain is no longer interesting to me, right? This has so much less volume in OI that I'd rather go with the chain. Maybe if it has a bit less time, I'd rather go with that higher volume and higher open interest. Reasoning behind that is something that generally applies to contracts that are a bit less liquid, but still certainly is important. Again, as you mentioned before, it represents kind of overall market interest in a contract. And if you're trading an equity that's a bit less liquid, like for example, something like maybe like a shop, that's going to matter a whole lot more, because as that volume and OI drops off, like for example, the at the money, or I guess a little bit out of the money, we have the September 24th 73 calls or the 72 calls. Notice the spread between the bid and the ask of these contracts, right? This is about a 25-cent spread here, and about I can't do the math quickly enough, 14-cent spread here. Whereas the contract with the higher volume and higher open interest, although it's priced differently, the overall ratio of the spread to the price is lower. So this has approximately a 7%, or excuse me, about a 10% spread between the bid and the ask. And what I mean by that is the bid price is $66, the ask price is $73. So what I'm doing in my head is I'm subtracting the bid price from the ask price, and I can even pull this up really quick and write it down just to make it clear. So let me just write this down. Bid price is 73. Well, that's the ask price. Bid price is 66. So subtracting the two from each other gives us a spread of 7. That's right. Right, yeah. Spread of 7. And then ratio of bid, ask, spread to contract price. I'm dividing the spread by the ask, which gives us approximately a 10% ratio on this one. Bear with me. Whereas when we look at this for something with a bit less liquidity, right? So this this contract, which is the 72 call, this one has an ask price of 176. This one has a bid price of 148, which gives us a spread of approximately, what is that? 28, which the ratio there is, let's see, 28 divided by 170, or so it's like 15%. 15%. So essentially, what we're seeing here is the difference between the bid and the ask price is marginally larger on this contract here with lower volume and open interest than the contract with higher volume and open interest. And there's obviously other things to consider here, but this is kind of an important metric. And the reason why this matters is because generally speaking, right, if you're looking to get into a trade reasonably quickly, you're going to buy at or near the ask price. And if you're looking to get out of a trade reasonably quickly, you're going to sell at or near the bid price, which this is where this ratio comes into play. So if I marketed in and out of this contract, I would instantly be down 15%. Whereas if I marketed in and out of this contract, I would instantly be down 10%, which obviously both options sound bad and both options aren't good ideas. But it puts things into perspective and kind of why that volume and open interest can be a really quick metric to look at when you're trying to select a contract to figure out which one is the most viable. And there's other ways to determine kind of if the spread is reasonable or if the contract will be reasonable, and we'll continue to cover that. So that's kind of rule number one in terms of looking for contracts, is taking a gander at the volume and open interest and making sure it's reasonable, and it'll give you an opportunity to get in and out of the contract reasonably easily. Does that generally make sense to everybody? What's up, Norman? Good to see you. Crack, no, I don't trade 0 days. I'm only ever trading 0 days if I'm trading with flips. I never am trading alone 0 days typically. Flips is the crazy one who gets involved with that. I don't know how he does it.
Yeah, we got paid already 2 days in a row. On 0
Yeah,
days.
that's how you do it, bro. I can't get involved with that. It stresses me out too much. All right. So moving on, volume and open interest, definitely the first two important metrics to watch out for. Next up, generally speaking, there's a couple Greeks to pay attention to. I think the most important is understanding, number one, the larger the theta, the quicker your option contract will decay, which I have PowerPoint slides on this, but I'm going to kind of stray away from them for now. And next is really your delta. And that's kind of the next most important thing to understand. So generally speaking, the contracts that are closest to the money, meaning, for example, SPY is right now at 551.5 in the after hours. So 552 is really the closest to the money contract. It has a delta of about 0.5. As contracts go deeper in the money, which you'll see here, deeper in the money, you'll see that delta approach 1. And as contracts go further out of the money, you'll see that delta approach 0. Generally speaking, what that delta represents is the amount of money that the option contract will increase in value per dollar in stock price change. So right now, if the S&P goes up by $1, this contract will go up by 50. And if you look at something like a weekly, it's the same thing, right? The at-the-money contracts are pretty close to about a 0.5 delta. The difference, though, is that the amount of money that you have to pay for that 0.5 delta is much less, right? So your same-day contracts are now about $140, But every dollar the stock goes up, your contract goes up $50 as well. So now you're getting, I don't know, 35-ish% return for a single dollar move in stock price. Whereas if you had something with a longer expiration, you'd be paying, say, $500 for that contract. And if the stock price goes up a dollar, you'd only be making about 10%. So that's a really good reason for people like Flips, and I'm sure a lot of you in the audience tonight who are day trading and more kind of short-term trading focused, to accept the fact that your shorter term contracts are going to have a higher theta, meaning they're going to decay quicker. However, the trade-off there is a larger delta to contract price ratio, right? So a lot of kind of the ways that you can select these contracts or analyze the value of them is doing these kind of simple ratios in your head, right? And it's really not something that you're going to calculate every single time. It's mostly just getting these kind of initial points of reference set. So general rules of thumb. In general, your shorter term contracts, so weeklies, same days, etc., are going to have a very high theta, standard delta, but a low price. So you have high decay. So the longer you hold that contract, the more money you're going to lose. But if the move happens in your favor quickly, which is generally what you're looking for as a day trader, you make a lot of money. Or you could lose a lot of money if it goes out of your favor quickly. Important to manage risk first. Then, if you think about that same scenario for a longer term expiration contract, you have that same delta, but a much lower theta. So if I'm not right instantly, which if you're trading a daily or a weekly setup, you shouldn't expect to be right instantly, your theta is so much smaller, right? Here, if I tried to swing this tomorrow expiration contract, I would lose instantly about $140 overnight, which is effectively the whole contract value. Where if I hold this other contract with longer expiration overnight, I only lose about $26, which is much less significant. Does that make sense? So that's really outlining essentially why it's important to choose the correct expiration date for the type of trade that you're taking. Obviously, we haven't covered strike price yet. However, the expiration date has a massive, massive impact on the type of trade you're taking. And I just want to highlight that with one more example. Let's say, for example, I'm taking a swing trade short with these 550 puts on SPY. The reason that's generally a bad idea unless you're sized 4-0 is because the theta on that contract is $200 and the price of that contract is also $200. So in theory, if the stock stays flat overnight, this contract probably ends up being worth around 40 to 50 bucks in the morning, which that's a massive loss just from holding overnight. Where if you wanted to take the same trade and just add a little bit of time, right, the 550 put for 9 days expiration, it costs about $560, but the theta is $35. So if the stock goes absolutely nowhere overnight, you're only out less than 10%. It's like 7 or 8% loss on your contract. Whereas shorter term expiration, you're down 80, 70% at open if nothing happens.
So what happens if that contract with shorter time frame, so everybody understands, opens in the money?
Right. Yeah, that's a very good question, Flips. Yeah, if you get that move in your favor, obviously it's a massive win, right? The delta relative to the price that you're paying for the contract, I mean, it's a big, big win, right? There's no way to deny that. But that's also there's a lot of risk that you have to take on in order to have the potential to gain that, which is why when people like Flips are taking those sorts of trades, you're sizing down, right? You're not putting 10%, 5% of your port in a trade like that. It just doesn't make any sense and it's not sustainable, right? But good point, Flips, is there's definitely a time and place for those types of trades. And I know it's something that you like to do, Flips, and I can't act like it's not possible because it certainly is. But the sizing is very important too, right? You're not putting, well, I guess you might be a little bit different, Flips, if you're doing a challenge or something.
It doesn't change for me either. I agree with you 100%. Like, for example, if I swing some spy calls expiring tomorrow, I'm swinging 2 contracts. I'm swinging, I think it's like $220, where my regular position will be roughly 3 grand. So I'm
Yeah,
not, I'm position sizing maybe 7% of of my regular position. If that
yeah,
kind of,
that's like,
in my
yeah,
regular, it will be, let's say I want to do 5%. So I'm doing 7% of my 5% to swing. So when you downsize to swing, you have to be able to understand that you have to downsize always, because you never know what the market might do overnight. So
right.
especially with the time decay on it, like what you explained. Somebody DM me say what happened with the contract that Toast is talking about, and it opens in the money. So that's why I opened it for you for everybody.
No, it's a great question, right? And yeah, I think it's you have to be mindful that there's risk to every trade that you're taking, and the risk you have to be managing that every single trade you take, right? It's not something that you can forget about. That's more important than thinking about the profits every single time. So yeah, sure. If you wanted to try and swing these tomorrow expiration puts every single day and kind of go for that big win every day, I'm sure it works sometimes, right? I know Flips is going to hit those sometimes when he swings those weekly Teslas. Sometimes it works, right? But you're not sizing like a normal position, right? So you're putting much less money into that position in order to help mitigate the risk that you're putting yourself through, right? With trading a contract like this and swinging it, right? There's a reason that typically you see Flips, Flips, feel free to stop me if I say something wrong, but there's a reason that you see Flips day trading, maybe 5, 10 different trades with these contracts, but maybe swinging one trade with these contracts, right? The whole idea of these short-term expiration contracts is to be in and out and not hold on forever. And when you do hold, you really need to understand that there's an elevated amount of risk to that, and you should be finding some way to mitigate that, whether it's sizing down or, yeah, just being prepared to lose more money. That's a great topic, though, and I think a really important one to hit. Anything else to add on that, Flips?
No, I mean that's really, you just said it. Have to manage your position is key. Due to the fact that many people, they say, I have to make my money back. So my regular position is $300. So, but I'm gonna swing 1,000. You're like, dude, you're doing it backwards.
Right.
And sometimes, yeah, you can hit and you're gonna brag about it. You're gonna be excited, but that is not smart trading. And if you're trying to do this for the long term, that's how you blow your port. So
Yeah, if you're Flips, you just don't lose, so you don't have to worry about it. Yeah,
yeah, whatever.
no, it's super easy to get caught with that sort of thing. Like, let's say, for example, like on Friday, right? You see what looks like a decent breakout, right? Maybe this little like tiny flag breakout on increasing volume, whatever you want to call it. So you decide to swing Monday calls, expecting a big gap up through all-time highs. At open on Monday, you're wrecked. Like those contracts are literally worthless. Whereas if you swung something, right, with actual time on it, 1, 2, 3 weeks time, yeah, it's still going to hurt at open, but you actually have the opportunity to stop out still and protect some of that capital that's left over. But if you just swung weeklies, you're toast at open on Tuesday, right? That money's literally gone. So another kind of point of view as well. All right. So let's start to talk a little bit about strike price. I guess actually, wait, let's recap kind of the rules of choosing the expiration date, right? Generally speaking, a day trader, very common for a day trader to take expirations that are weekly, same day, maybe next week. Swing trader, very common for a swing trader to take expirations 2 weeks and further out, right? Those are very general rules. I want to make it clear though, it is possible to swing trade a weekly contract, like we just discussed. And it is also possible to day trade a contract with 2, 3 weeks expiration. Like, for example, if you're trying to day trade with Flips and you're trying to follow some of his positions and you're going to walk away from the computer, it might not be a bad idea to add a week or 2 weeks on the expiration date. So if you're not actively listening or actively watching the chart, you could set a couple alerts, and if you miss it, you might lose 10, 20%, but it would be much better than the same proportional loss on a weekly or same day. So those are kind of the general frame rules to keep in mind, right? Again, just to recap one last time. For choosing expiration dates as a day trader or a scalper, the expirations you typically want to get involved in are short term, so under 2 weeks. As a swing trader, the expirations you typically want to get involved in are medium to long term, over 2 weeks. That is not set in stone. There is definitely kind of blurred lines between the two. So don't take this as this is how it always has to be on every trade. This is strictly meant to be just high level guidance in a general way for you to select your contracts, right? There is a reason that some of the swing traders in our Discord server typically have that longer amount of time. And there is a reason the day traders and the scalpers typically have much less time. And hopefully we understood or we explained the theory well enough for it to make sense to everybody. Any questions or comments before we start to talk a little bit about strike price, how to choose different strike prices? Anything else for you to add on that expiration date flips?
No, that's exactly it. I play weeklies and same days about 95% of the time. If not, then I'm playing, if I like a position, I will only swing trade when a stock is extremely oversold or overbought. So
and you'll notice,
it went to shit, like dropped a lot, I'll buy a month out, one contract call. If it's overbought and it's like peaking, I'll buy one contract, month out put. And I'll just leave it there.
And it's funny, Flips, you said, sorry, go ahead.
Go ahead.
No, you said 95% of the time it's a daily or weekly. And what does Flips trade 95 or what is Flips doing 95% of the time? Day trade.
Day trade.
In BC. There's a reason for that. It's not by accident. Cool. All right, I think we hit that one home. Thanks for the help on that one, Flips. That was great. All right, let's talk strike price. And I know the guidance that I'm about to give is the way I'm about to present it is actually kind of similar to how Flips has presented it in the past. So similar to choosing an expiration date, there's no real set in stone way to always choose a strike price, right? It can be variable. It can be very different. So we'll talk about a couple examples after we talk about this first general rule. Typically, it is best to choose a strike price typically less than 10% out of the money. So what that looks like is, for example, SPY is trading at, okay, this is actually kind of a bad example with the SPY because that doesn't really go so well. As a day trader, I'll give two separate ways to think about this. As a day trader, you should likely be picking, generally speaking, the contract that is either the first out of the money contract, the second, or maybe the third as a day trader. And the reasoning behind that is because as you go further and further out of the money, the delta gets smaller and smaller, the theta stays huge, but the price also decreases. So you're essentially getting less of a reward for a lower price the further you go out of the money. And again, just like we talked about earlier, there's a time and place for the random far out of the money contract, right? But generally speaking, as a day trader, your plan is to look for a couple dollar move, right? You're not always looking for the home run. There's a time and place to kind of position yourself for those home run type of trades, right? Maybe an FOMC, you'll go for something further out of the money. Maybe before earnings day, you'll go further out of the money. Maybe at the end of a quarter or end of the month, you'll go further out of the money. But generally speaking, you should likely be choosing the strike price that is the first, second, or third out of the money contract. Reasoning behind that is, again, right, that delta is sufficiently large enough to the point where if you get even a small move in your favor, you're going to see profits very quick on that, right? Or if you get a small move out of your favor, you're going to see the loss very quick on that. Whereas with these further out of the money contracts, you're going to need a larger move to see profits. But if you do get a larger move, you're going to get a much better return on the further out of the money contracts than the closer to the money contracts. So again, it's really, again, an exercise of balancing risk versus reward, right? As you go further out of the money, the risk increases, but the potential reward also increases if you're sizing or looking for a larger move. Anything else to add on that piece, Flips? Flips is gone. Maybe later.
No.
Oh, he's here.
I just couldn't find it. No. That's exactly what it is. I mean, you can't like you literally explaining it the same way that I will be explaining it.
That's what I figured. Yeah, I remember you said that.
Yeah.
You said you picked the first 1 or 2 strikes. And I was like, that's a great way to put it. Yeah, just say that. It's easy.
If it's many times people are like, hey man, how come your contract is up 60% and my contract is up 10%? And I said, well, what strike did you take? Well, I'm like $15, 20 contract out of the money. And I'm like, well, that's the reason why. You can explain the Greeks why. But yeah, it's way different. Two contracts out of the money than 10 contracts out of the money. So we're not going to get the same percentage at all. Even if your contract is $40 and mine was 400, my 10% is going to be your 1%. So
right.
yeah, you have to know. And if the contract is too expensive for your port, don't trade it.
Yep. Yeah. Migs asked the question, what if you have a small cash account and can't afford the first 3? That means you probably shouldn't be trading that stock.
Yeah,
So
don't trade that account.
there's thousands of names to trade in the market and hundreds of quality optionable stocks to trade. So if, for example, you have a $200 cash account and it's not a Flips Challenge account that you can YOLO, you shouldn't be trading this, right? This is more than 50% more than 50% of your portfolio. So at that point, you need to trade something else, right? 2 stocks that are disgustingly cheap and great to trade are AT&T, and Coca-Cola, right? Great stocks to trade, especially as a beginner. They move great. You can get plenty of time on them for cheap, so you don't have to deal with the volatility of a weekly or a next week. You can pay for the time. It's still cheap. It's easy to get in and out of. It moves slow. It's a great trader. It's the perfect names for beginners to learn on. And most beginners won't take that advice because they want the quicker returns. They want the higher volatility because they think they're going to make money quicker. Really, they're just going to lose money quicker. And that's the reality, Flips. And I know you've seen it. You got to really, if they're learning with us, hopefully they're not doing as bad. But generally speaking, a lot of beginners want to chase that volatility, want to chase the quick returns, which comes with the highest volatility contracts, right? The SPX, the weeklies, the same days. Really, if you want to learn how to trade options, this is the best place to start outside of trading shares.
Yep, I agree with you 100%. I mean, for the people that ask me about why do I trade same days, if you notice, I don't trade very big positions, and my stop loss is very tight, and all I'm looking for is that the levels, my resistance supports, my EMAs, and my Fibonacci extensions, plus my time and sales, and my level 2s, they all match. If they match, I give you the exact level where I'm looking for. I'm looking for 5-6 reasons why my trade needs to work, and most of the time I'm looking for 5-6 reasons why it shouldn't work, so I can counter my. You don't stay blinded by what you want to see and not the real picture. So,
right,
yeah, man, you got to play them correctly.
Right. Great points. 6 says, how far out of the money would be a bad play? I want to really be careful with how I answer this question, because just because you're taking a contract far out of the money does not constitute a quote unquote bad play, right? River all the time takes these far out of the money contracts, right? Because he will be in and out quick. He's looking for a 5-10% return sometimes, and that's it. Which these far out of the monies, you can get that pretty quick because they're so cheap. For example, this 556 call is $30. The delta is 15. So every dollar the SPY moves, that contract goes up 15%. So SPY moves $1, that contract's up 50+%. If SPY moves, 50 cents, it's up about 25%. If it moves about 25 cents, it's up 10%, right? So as a scalper, you could really go either way. It doesn't hurt. It really comes down to how you want to trade those quick scalps, right? Again, great question for River probably is how he decides if he wants to go further out of the money or at the money. I'm personally not as much of a scalper. Flips isn't really much of a scalper either, as far as I understand it. It's really River is the guy who will scalp a contract like this, and he will take a $3 return on a contract like this just because he can. It's how he likes to trade. It's quick. He's in, he's out, and that's the end of it. So I can't say that it would be a bad idea. Again, it just goes back. The type of trade that you're taking should heavily influence the contract you're selecting. And that really needs to be the lesson coming out of this lecture, is that there's not really a framework for the right contract for every trade. It comes down to a couple things, right? There's those general guidelines, and then also comes down to your style, right? For example, there's plenty of people who day trade contracts with 2 weeks till expiration just because they don't want to see the volatility of the weekly. And that's something that I would do, right? I personally don't love all the volatility on the weeklies and same days. So if I'm going to take a day trade, I'll have a next week contract or a week after contract because I don't mind having a less return for the lower volatility. Yeah, Six, this is an interesting question. Does 5 $30 cons farther out of the money get you a different return versus one $150 contract closer to the money? The answer is yes. That concept that you just described is called stacking your delta. So let's just do the math on that really quick. So we have to remember that delta is the only way we make money on option contracts. And that's not necessarily true, but for the purpose of this lecture, let's just say that. So if we choose this 552 call, the delta is 4.6. So every dollar the SPY increases, we make 46 bucks. The delta on the, let's see, 555C is about, oh, I moved it too quick. Delta on the 555C is about 21. Let's say, for example, this contract is $140 because it is. So we pay for the 552C, we pay 140 for the 46 delta. For the 555C, we pay 555C, we pay 50 for 21 delta. And we can buy 3 approximately of these 555 calls for the price of 1 of these 552. So if we have 3 555 calls, we pay 150 and the delta becomes additive, right? So we have $150 in contracts, and now we have a delta of 63. But every other Greek is also additive, right? So the theta then stacks on. So now we have a theta of, let's see, 150, whereas here we only, we have a theta of 150, where here we only have a theta of 140. Couple other things, but this is a concept called stacking your delta. Again, right, it just comes down to the type of trade that you're taking. And this is really, I think, the big idea of how River likes to scalp, right? He could get 1 of these 552 calls for this amount of delta, or 3 of these for this amount of delta. As a scalper, you're not in a trade for more than 5 minutes. And if you are, you're wrong. So at that point, you don't really care too much about theta, because the big idea is to get in and out. Yeah, Migs, this is an interesting question. What about tickers like SMCI, where the first 5 to 10 contracts are in the thousands, but the premium spikes really fast up and down? So comes down to a question of how far out of the money is reasonable. And this is where that kind of rule that I was talking about before makes a bit more sense. For a really expensive stock like this, you really like the max you should ever be out of the money for most trades, unless it's a leap, is 10%. So what I mean by that is the stock price of SMCI is 423. So 10% of that is $42. So the farthest out strike you should realistically be buying is the 460 strike. And we can take a look at volume and OI here. 460 strike is decent, right? It's a $40 spread. Outside of that, it just becomes more and more unreasonable. And any move against you will hurt even more in terms of the loss. I'll also say, you don't have to trade every stock. Like if SMCI is a very expensive contract for these more reasonable strike prices, you don't have to trade it, right? Just don't trade it. And that's something that happens sometimes. Later, Flips. Thank you for being here. Always appreciate it. That was a good time. Good to catch up with you, dude.
Yeah, bro. Thank you, guys. I'm out.
Have a good night, dude. See ya. All right. Yeah. So that's one example of, a stock that you just don't need to trade. Another one that I thought I would want to trade a while ago, but just don't want to is ARM, right? The volatility on this guy is just not worth it to me, right? So you don't need to trade every stock in the market or every stock that has options available. And that's a really important thing to be mindful of, is just because it's tradable, just because the setup's really good, if one stock is set up really good, there's always going to be another that has a similar setup. You just got to go looking for it. So yeah, SMCI also isn't one that interests me too much at the moment, but anyway, that's another discussion. But yeah, it's a great question, right? You have to trade with names that are reasonable for your portfolio as well. And that's a big part. It's not even really selecting option contracts, but just selecting stocks to trade, right? It's an important question to ask yourself is, should I even be trading this stock, right? Sometimes the answer is no. We're getting close to the end here, so I want to just open it up for any general questions that we have. As we get close to the end, how's everybody feeling? Is everything kind of making sense? I think the weird thing about selecting options contract is it's really less of a it's an art, not a science, right? Just like everything in trading. There's a lot more to it than simply just saying, yes, we need to buy this contract for this type of trade every single time, right? It doesn't work like that, unfortunately. And this also looks very interesting. Dollar Tree. This reminds me a lot of AT&T a while ago. Anyway, yeah, very important to note that. Learned a lot about choosing your strike. Usually just use the cheapest with the most volume. Yeah, so cheap does not equal good. That's a very important thing to be mindful of. Just because a stock is cheap does not mean it is good. What makes SPX so volatile compared to others? Oh yeah, great question. Yeah, so SPX, obviously the price of these contracts is much higher, right? Price of the contracts is much higher. And if we take a look at this really quick, for example, SPX, let's just take a look at SPX today. Today alone, SPX from today's high to today's low, 5554 down to 5503, right? So SPX moved 50 points today, 50 intraday. The delta of these contracts is still $51, right? Just doing the math really quick, 50 times 50 is 2,500. So this contract right here likely fluctuated $2,500 during today. And I think the reason SPX feels so much more volatile than other things is just because it's more expensive, right? Like you could trade $100 out of the money SPX, and since it's still expensive, you think it's still like, not that volatile. But all things considered, SPX is not any more volatile than SPY. It's just more expensive. And I think that's kind of an interesting misconception, is that SPX is more volatile, when in reality, it's really just 10 times SPY. Like if you look for an equivalent contract on SPY and bought 10 of them, it's effectively the same. Now, obviously, there's always going to be some differences. But really, SPX is just a more expensive version of SPY. That's it. Yeah, man, you said it best right there. SPY moves 3 to 5 cents per second. SPX moves 30 to 50 cents. But yeah, every second, every tick, SPX moves 30 to 50 cents. That's like the minimum tick size. Whereas SPY, obviously, you'll see it move a penny, 2 pennies, where the minimum SPX will ever move is 10 cents. And typically the moves are much larger than that. So anything that SPY does, SPX does 10 times that. So correct, Armando. Yeah, that's the rough math. But again, it's not exactly, there is a bit of nuance that makes SPX like technically slightly more volatile than SPY. But again, generally speaking, right, trying to keep things simple, SPX is really just a more expensive SPY. That's pretty much it. And if you went and traded a contract that's I don't know, X amount percent out of the money on SPY, it would do the same thing. I think the reason that it's just more practical to do something like that on SPX. Like if you go and trade a contract that's 10% out of the money, that's the same day on SPY, it doesn't really exist or far out of the money. Like let's just look at this really quick. 1, 2, 3, 4, 5, 6, 7, 8, 9. A contract 10 strikes out of the money on SPY is $3, right? For tomorrow expiration. Whereas a contract that's 10 strikes out of the money on SPX is 2, 3, 4, 6, 8, 9, 10. A contract that's 10 strikes out of the money on SPX is $400, right? So SPX has a lot more strike prices just inherently built into it, which gives you a little bit more flexibility to like find exactly what you're looking for. So there's some nuance to SPX, but generally speaking, all SPX is just 10 times SPY. That's it. There's nothing else to it. Great questions, everybody. Really, really good questions. All right, Norman, just for you, this is how we're going to close out the lecture. We're going to look at your whatever stock of the day this exists. Looks all right. Nice little retest here, these previous all-time highs. The daily is an absolute mess, though. I mean, this thing is pretty disgusting. I mean, I can't say I love it, but I mean, if you like it, I guess you got to be long as it's holding this 49.50 area, approximately. Looks terrible, though, honestly, Norman. I'm not going to lie. It looks like there's so many gaps, not very liquid. I don't know, man. This one's not for me, Norman. I'm not going to lie. But more power to you, my friend. I like the VRT better. That was a fun one for a while. VRT was an absolute print fest. Oh, wait, what happened to all the levels? Oh, yeah, here we go. Yeah, this was an absolute print fest, Arvin. This was nice the whole way. Cool. All right, everybody. Well, that's really going to do it for us today. As always, appreciate the attendance. Appreciate you guys being here. The questions were great tonight. And yeah, we'll see you guys all in the next one. If you have any questions, comments, feel free to reach out. And yeah, have a great rest of your evening. Thanks so much, everybody. And we'll talk to you soon. Adios, everybody.